Disclaimer: this video is for informational and educational purposes only and should not be considered financial, investment, or legal advice. The views expressed are based on research and personal opinions and may not reflect the latest market developments. Always conduct your own research and consult with a certified financial advisor before making any investment decisions. Investing in mutual funds, ETFs, or any financial instruments carries risks, including the potential loss of capital. Past performance is not indicative of future results. The creator of this video is not responsible for any financial decisions made based on the information provided. Viewer discretion is advised. Imagine this. You're 25 years old, and you've just started investing. You've got $1,000 to put to work, but you're stuck between two options: mutual funds or ETFs. Which one should you choose? And more importantly, which one will help you build the portfolio of your dreams? By the end of this video, you'll have the answers. Let's get started. And no, this isn't about picking the shiniest option. This is about picking the one. Before we dive into which is better, let's break down what mutual funds and ETFs actually are. Mutual funds. A mutual fund is a pool of money collected from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. They're managed by fund managers who make investment decisions on your behalf. They often come with higher fees because of the active management. You can buy or sell mutual funds only at the end of the trading day, at the fund's net asset value. Think of mutual funds like a luxury car. It's comfortable, comes with a chauffeur, but it's also expensive to maintain. ETFs, exchange-traded funds. ETFs are similar to mutual funds but trade like stocks on an exchange. Most ETFs track an index and have lower fees. You can buy and sell ETFs throughout the trading day at market prices. ETFs disclose their holdings daily, so you always know what you're investing in. ETFs are like a self-driving electric car, efficient, cost-effective, and you're in control of the ride. Now here's the million-dollar question: which one is right for? Let's find out. Check one, check that. Let's compare mutual funds and ETFs across 5 key factors. Cost: mutual funds have higher expense ratios, ranging from 0.5% to 2% annually. ETFs have lower expense ratios, from 0.03% to 0.2% annually. Over time, those fees can eat into your returns. Imagine losing thousands of dollars just because you didn't pay attention to costs. Flexibility: mutual funds are only traded once a day. ETFs are traded throughout the day like stocks. With mutual funds, you're stuck in a monogamous relationship. With ETFs, you're playing the field. Tax efficiency. Mutual funds are less tax efficient due to frequent buying and selling by fund managers. ETFs are more tax efficient because of their unique structure. Warren Buffett once said that costs and taxes are the two biggest enemies of investors. ETFs help you fight both. Minimum investment: mutual funds often require a minimum investment like $1,000 or more. ETFs allow you to buy a single share, making them more accessible. With ETFs, you can start investing with as little as $50. That's less than the cost of a fancy dinner. Performance. Some actively managed mutual funds outperform the market, but most don't. ETFs typically match market performance, which is often good enough. The Spider S&P 500 ETF, SPY, has delivered an average annual return of 10% over the past 30 years. That's the power of passive investing. Now that you know the differences, here's how to choose and start investing. Step 1. Define your goals. Are you saving for retirement, a house, or just building wealth? Your goals will determine your investment horizon and risk tolerance. Step 2. Assess your budget. How much can you afford to invest regularly? Remember, consistency is key. Even small amounts can grow over time. Step 3. Choose the right option. Mutual funds are ideal for hands-off investors who want professional management. ETFs are perfect for cost-conscious, hands-on investors who want flexibility. Step 4. Open an investment account. Use platforms like Vanguard, Fidelity, or Robinhood. Link your bank account and start funding your portfolio. Step 5. Monitor and rebalance. Review your portfolio regularly. Rebalance if your asset allocation drifts from your target. Think about it. If you started investing $100 a month today, where could you be in 10 years? The answer might surprise you. Here's the bottom line. Both mutual funds and ETFs have their pros and cons, but the best choice depends on your goals, budget, and investing style. But what if I told you there's a third option that combines the best of both worlds? Stay tuned for our next video to find out. If you found this video helpful, hit that like button, subscribe to Better at Finance, and turn on notifications, because your financial freedom starts with the right knowledge. See you in the next video.